Online's the headlines at this hour. Markets look set to post seven straight weekly gains as corporate earnings meet expectations.
Emerging markets have peaked, says Jonathan Garner of Morgan Stanley. The Asia strategist tells Bloomberg that foreign inflows are bound to fall in 2018.
The GST Council revises rates for 29 goods and 53 services, also mulls simpler return filings.
And Singapore Stock Exchange's plans to introduce single stock futures gives NSE cold feet. The country's largest equity exchange fears a sharp drop in volumes.
All right, quick check on how the markets are faring at this point in time. We're seeing the Sensex and the Nifty pretty much where they began the day at 10,831, 14 points marginally. Some of these individual stocks where you saw earnings have reacted quite positively. ITC, for example, you did see the stock go up significantly after numbers came in, but it stabilized about 0.7% in the green today. Other banking counters, Kotak, HDFC Bank, these are stocks that have reacted to earnings announcements as well. 0.5% up on Kotak Bank, HDFC Bank on the back of that divergence announcement that came in of about 2,000 crore is trading about 0.7% in the green as well. The mid caps particularly are also not doing too much today. You did have some of those stocks have been moving quite volatile, but on the whole, the markets are pretty much where they are when they opened for trade this morning. Not too much volatility you're seeing in trade today.
The general trend on the market so far seems to be higher, but emerging markets could be very close to their peak. That's the word coming in from Chief Equity Strategist at Morgan Stanley Asia, Jonathan Garner. EM equities attracted more than $100 billion in 2017, a feat that can't be replicated this year, says Garner. In a conversation with Bloomberg News, he said that there is reason to be cautious. Listen into a slice of that conversation.
Firstly, and most obviously, central banks are tightening, and that's begun in the US, but China has been engaged in ongoing tightening. You were just covering how good the China macro has been, but inflation is picking up there, particularly wage inflation. We've also got commodity prices on the rise, and that combination, particularly an oil price increase and increases in wages worldwide, that will eat into corporate profit margins, particularly out here in Asia, that's a big oil importer.
Right.
And then at the same time, we have a situation where valuations, and this is really the clincher, are exceptionally high, really other than in two sectors, financials and energy, but everywhere else we have valuations that are really 95th percentile or higher of the long run history.
Is this just, though, Jonathan, as you're describing this, just an emerging market scenario here? Are we talking also about U.S. markets as well, and in Japan and elsewhere?
Yeah, so there are very few places in the world now where we haven't exceeded our base case targets. So our base case target for the S&P is 2750. For topics, it's 1820, Hang Seng 31,500. So now what we're doing is moving from kind of our central scenario that we thought markets could get to into a more kind of bullish state of euphoria, particularly on that valuation overshoot, which is typical of an end of the cycle situation. Very large retail investor inflows. Emerging markets had $100 billion of inflows last year, and that won't continue.
Jonathan, some say that if you track these movements in stocks, that is an indicator for the economies as a whole. We know back in 2000, what we found after with the dot-com crush is recession, particularly here in the U.S. and elsewhere. Are you seeing that is possibly going to be the case as well if we do in fact experience a crash on the magnitude of what we saw in 2000?
Well, the 2001 recession, I don't think it was really caused by the stock market declines of 2000, but certainly there are problems starting to appear, particularly in lower quality corporates in relation to the amount of leverage that they've taken on. So if you look, for example, at, say, the high yield part of the US credit market, we've already recommended going underweight that. And if you look out here in Asia, I think one thing that we really are interested in is the fact that the semiconductor tech hardware sector has stopped outperforming. So we made a big call 2 months ago to rotate into the final things that move in a bull market, which is energy, upstream energy, and financials. So the outperformance of upstream energy, and in fact the non-Asian parts of EM, like Brazil and Russia, that's ongoing now, that's a classic right at the end of the cycle phenomenon.
Jonathan Garner of Morgan Stanley, and here's an interesting perspective. He believes that emerging markets have actually peaked, and then foreign institutional investor flows into EMs are likely to sort of peter out. But here's a counter view, and the counter view is, and this is a chart, even after handily beating American stocks last year, Asian shares have actually gotten relatively cheaper to US counterparts. This is an interesting chart that gives you a sense of where valuations are. And not just in India, all over Asian markets, we've been talking about how valuations have gotten expensive and therefore the upside to the markets may be limited. But just compare this, and this is just a comparison between two spreads. The white line that you're seeing is the forward PE. This is the spread between the MSCI Asia Pacific Index and the S&P 500, and the blue line is actually price to book. Again, spread between MSCI Asia Pac and the S&P 500. And if you just look at the spreads on the forward PE, it's actually trading at a 13-year low, which means relative to the US markets, Asian stocks are continuing to trade lower from a valuation perspective. Does this indicate there is more upside for Asian markets? Yes, it does. Whether liquidity will follow, we don't know. Somebody like Jonathan Garner believes that foreign flows are not directed towards emerging markets, at least in 2018.
Interesting. That's the relative valuation and what it could mean for fund flows. Let's move away from the markets. Simplification of filing GST returns, a transition to the e-way bill, and of course also a breakup of the IGST between the centre and the states were some of the issues addressed at the 25th GST Council meeting that took place yesterday. The Fitment committees recommended that there will be lower rates on 29 goods and about 53 categories of services. This recommendation was accepted by the Council. The new rates come into effect on the 25th of January. Let's first hear out Payaswati Upadhyay reporting on the key takeaways and the important aspects of that GST Council meeting.
In its 25th meeting, the GST Council has taken several very important decisions, and I'd like to highlight the three key ones. The Council has decided to provisionally divide 35,000 crore rupees between the centre and states from the integrated GST collections kitty. This is to meet the shortfall of revenue collection that the states were facing. The second is on the simplification of the return filing process. The expectation was that there will be a simplified return filing process that will be announced by the GST Council, but they've sought more time on it, and they've said that they will discuss it in a video conferencing meeting that will happen in 10 days from now. The Council has also reduced the GST rates on 29 goods and 53 categories of services, and here I'd like to highlight two categories that stand out and are very crucial. The GST rate on construction of metro and monorail projects has been reduced from 18 to 12%. Also, GST rate on transportation of petroleum crude and petroleum products is reduced from 18 to 5% without input tax credit and 12% if you're going to avail of the input tax credit. In the fine print, there are also two other very important clarifications. One is on the value of, they have clarified that the value of exempt supply will not include the value of deposits, loans or advances on which interest or discount is earned. This will essentially be very useful for companies who have a major amount of interest income in their books. So what happens is when the interest income gets qualified as an exempt supply, you don't get credit for it. This was essentially meant for banks and NBFCs whose majority of income is interest income, but it also inadvertently brought into the fold a variety of companies who have a majority of their income as interest income. So it's good news for these companies. Secondly, the Council has also clarified when GST will need to be paid in a transaction that involves transfer of development rights. So what happens is when a landowner and a developer enters into a JDA or a joint development agreement, the landowner transfers the rights in the land to the developer. So the question was, when does GST need to be paid? At this stage, but there is no cash transaction that is happening at this stage. Only the right is being transferred to develop that land. So what the Council has clarified that this will need to be, the GST will need to be paid at the time when the possession of the right and property is transferred to the landowner by entering into a conveyance deed or similar instrument. But this deferment in point of taxation will not apply to the cash component.
Okay, Payaswati, thanks for that. Let's talk about the impact. Which companies are likely to react to these new rates? Darshan is here with a list of stocks that may be impacted by these changes. Darshan.
Yeah, so Harsha, not too much of an impact except for the amusement companies, but sentimentally positive for Maruti because the GST on old cars has come down both on the large car and SUV and on the other car. So it's positive because the old car market was simply not moving because of high GST rates. So now there could be a potential, and replacement market is a big market for Maruti. As far as sugar boil confectionery is concerned, it's positive for PNG because one of their key products, Wix, uses that. As far as cigarette filter rods are concerned, no material impact because the prices have gone up and they already paid something extra apart from the GST. Diamond and precious metals, yes, it's positive for companies like Titan and PC Jewelers. The other companies that we need to watch out for where the impact will come in, first of all, drip irrigation, Jain irrigation, extremely positive, and this has been spoken about for a while that the need to get down GST rates for important irrigation projects is strong. Construction of metro and monorail, positive for L&T. They're already doing the Hyderabad metro, but it also benefits companies like Simplex Infra as well as J. Kumar Infra. Transportation of fuel is positive for the oil marketing company. It's got down to 5%. For mining exploration services is positive for companies like Reliance, ONGC and Kane India. So it's upstream here. And finally, admission to theme parks. This is the big one. 28% was the earlier rate. Now it's got down to 18%. It's positive for companies like Wonderla as well as AdLabs. The management has been indicating that footfalls are simply not happening because of high rates. Because of this, they will be able to pass it on and ticket rates will come up, and that will aid the footfall. So extremely positive, and the companies in the amusement space, amusement parks, sector are clearly buzzing in trade today.
Right, Darshan, thanks for that. We spoke to two managements, L&T and Wonderla, to understand how they see this development. Let's hear them out.
It is a positive step in many ways, more than one. Number one, the capex of metros will definitely come down. 18 to 12 is a big step. Bulk of the metros, as you know, are financed by the government itself through various loans that they take from multilateral agencies. Hyderabad is a one-off project which is financed by Larsen & Toubro, but most of the other projects coming out are government-aided projects. So the capex costs of metros do come down. Second is that there will be a significant reduction in working capital because a company like us moves resources from one state to the other. And in this kind of process, there is the fact that you pay the tax and then you wait for the credit later on, and therefore there's a significant blockage of money. Working capital coming down is a singularly a big financial movement.
Amusement park sector has been adversely affected because of GST. It was at 28%, which is much higher than what we were paying in the pre-GST era. Now they have, I think, recognized that, and they've brought it down to 18, which is a very welcome move for us. Obviously, our prices will come down by 10%, which is good, and so the customer will benefit from this, and we are hoping that will help us, bump up our footfalls.
All right, let's move on. The government has identified the 67 companies for alleged money laundering after the cash ban was announced. The government is now looking into the transaction done by these firms with other entities as well. Nikunj Ori, who's spoken to a government official, joins us with the details. Nikunj, what do we know and where is this investigation leading?
Post demonetization, the government had initially identified about 67 companies alleged for money laundering and depositing large amounts of money into their bank accounts and later withdrawing it. The investigation is currently ongoing on these 67 companies, and investigations are being conducted on companies that are associated or linked with these 67 companies. And remember, there are hundreds of companies linked with these 67 companies. A government official told reporters the real task for enforcement agencies now is to identify the real beneficiaries behind these fraudulent transactions. In a separate interaction with reporters today, Junior Minister for Corporate Affairs, Mr. P.P. Chaudhary, said that there were two companies identified that had deposited large amounts of money into their bank accounts and withdrew it later. These were one of the companies that was identified deposited about 3,700 crore rupees in its bank account and later withdrew it, while another deposited about 2,500 crore rupees in its bank account and the amount was later withdrawn. However, we do not know the names of these two companies, but we do know for sure that the government is going hard against these supposedly shell companies who undertook fraudulent transactions post demonetization. Over to you.
All right, Nikunj, thanks for that. That's an interesting development. Let's move on. Biocon, the stock of the company, jumped more than 3% in trade today after the company announced a global partnership with Novartis. The two drug makers will jointly develop, manufacture and commercialize multiple biosimilars for patients worldwide. Earlier, we caught up with Kiran Majumdar-Shaw to understand the contours of the deals and the opportunities that it offers. Let's listen in.
It is very expensive to develop biosimilars, and it takes anywhere between $100 to $150 million a piece. So, this is the kind of investment needs, and therefore to partner with Mylan, where we basically share the costs of development equally, you can understand the kind of investments that need to be made. But, the interesting opportunity for us is that we will be able to have a larger portfolio at basically half the cost.
All right, let's move on. Singapore Stock Exchange's plans of introducing single stock futures of Indian companies is giving the NSE some cold feet. The country's largest equity exchange is said to have requested the SGX to delay the launch. Sajid is here to tell us what NSE's reservations are. Sajid.
Yeah, we saw yesterday Bloomberg's Shantanu breaking the story that NSE has asked SGX to defer the entire plans to launch of single stock futures. Now, let me give you a background here. SGX already has Nifty futures there, and they've already started Nifty options. Nifty futures is a big product for SGX, and they have a licensing agreement with NSE. But to start single stock futures, they don't need a licensing agreement from NSE, so they can easily start. Now, what is the problem here is that a large part of that FI volume is coming into the stock futures. Already we've seen with the regulations getting tightening in 2017, we saw the ODI volumes shifting to Singapore, and now with this launch there, it will ensure that the remaining volume or a large part of the stock futures volume in which FIs are dabbling or are investing in the country again gets migrates, and that would hit very badly to NSE, because that's if you look at SEBI's regulation, SEBI's data which has come out for month of November, nearly 25% of the total open interest is with FIIs. So that's the amount which is going to be impacted when, if Singapore starts the single stock futures on Feb 5th.
But tell me, Sajid, does NSE have any locus standi to tell SGX not to do this?
It's a request.
It's a request. See, SGX has a stake in NSE, and they have a relationship going. As a part of the relationship, they have licensed Nifty futures in that country. Now, for single stock futures, there is nothing that you remember in the Raghuram Rajan days when rupee was under so much of pressure, and we saw the NDR market in Singapore being very active. The government couldn't do anything to stop it because it's a sovereign market, it's a free market. All that the Monetary Authority of Singapore said that if you see something unusual or something, you tell us, we'll take action against it. But it's a free market and they can do it. So today you have USD INR, which is taken off very well on SGX market, and a lot of FI volumes have gone to USD and INR there in Singapore market as well. So similarly, if when single stock futures comes in, subject to the approvals which are being awaited by SGX, it's going to be a good thing because it's a dollar-based contract. There is no translation risk which is there, and it's going to be easier for FIs to compliance and easy. And the cost of transaction in Singapore is much lower than India because you have your STT, you have stamp duties and other things coming in, which inflates the cost for India.
Sorry, I have one more question. Would SEBI have, you drew a comparison between this and the INR futures. There was a regulatory element that, your control over your currency goes off. In this case, would SEBI worry about individual stock futures? We don't know.
No. See, if SEBI will have worry because the exchanges are going to red flag it, saying that, our volumes are getting migrated to there. But the biggest worry is for the market and the market as a whole, because today you are looking at the data from the Indian market to look at how people are investing, what is the kind of sentiments coming in, or where the entire money is flowing in. Tomorrow you will have, if the stock futures, which mainly account for a majority of the market, because Nifty 50 futures is the one where you have a lot of trading that goes on. tomorrow you have to bring in the data from SGX to see, okay, how to get a view of the Indian market. Now that's what is going to be worrying for some of the market participants, because they've started saying that, already, if you look at Nifty futures open interest, it's $9 billion in Singapore as compared to $3 billion or $1 billion in India. So it's almost 9 times the open interest in Nifty futures, which is getting traded today. Today. So, when stock future happens, of course it will take time because the market has to be developed. And SGX is going to do a market making scheme where brokers will come and do a market making for it so that liquidity comes in. But as and when, maybe not now, 6 months down the line or 1 year down the line, this stock futures will develop into a bigger market there as compared to the domestic market.
Interesting story there. Thanks, Sajid, for putting that in perspective. Out of time on the show. Thank you so much for joining us today.
Countdown is up next.